our first panel discussion today is called Funding the Transition. Now, governments around the world, including where I'm sitting here in the UK, have lined up in recent years to set the target of their country being carbon neutral by 2050. Now, that's less than 30 years away, and it's a big job. And it looks like if we are to achieve this together, it will have to involve institutional investors due to the huge pots of capital they control and therefore the influence that they have. So what should pension schemes and insurers invest in? And how should they manage those investments to help the transitions to a net zero economy? Well, to find out, we have assembled a panel of people who are on the front line in this area. Cara, would you like to start us off with introductions?
Sure, happy to. And thanks so much, Mark, for inviting us on today. My name is Cara Milton Edwards. I am a product strategist in our iShares fixed income team. My kind of main conversations these days are really surrounding our iShares sustainable index range. So that covers ETFs, but also index mutual funds, and obviously when we're talking about institutional investors, segregated accounts as well. So really looking forward to the conversation today.
Ray, could you go next?
Sure, Mark. Hi, everyone. Hope everyone's doing okay. I'm Dhirani, and I head our sustainable finance team at WWF-UK. We work on policy, on regulation, and thematics like climate change, deforestation, biodiversity, etc. I look forward to it.
Great news. Thanks, Ray. Good to have you with us. Sheng.
Yes, everybody. Name is Sheng. I'm from BNP Paribas Asset Management, and I primarily cover green bonds at BNP Paribas Asset Management, as well as looking at financials, the financial sector from an ESG perspective.
Cara, could we start with you? Green bonds are one way of funding the transition, but is enough being done to ensure that the proceeds are not being spent on non-green projects and activities?
Yeah, I think it's a really great question, and it's certainly a question that we get from investors regularly in terms of, we often hear a lot of noise about green bonds when they're first issued, but how do we ensure once we hold them within our portfolios that they're going to kind of stay as green as they initially announced? And really within BlackRock and our index green bond fund range, where we have two products, an index mutual fund and an ETF, there's a two-pronged approach to really ensuring that those proceeds remain green. So the first is ensuring that we have a very stringent index methodology around that transparency of use of proceeds. And the second is very much relying and engaging on our own responsible fixed income investing team. So in terms of the index methodology, the flagship index provider here is Bloomberg, with MSCI providing the green bond analysis. And really at initial issuance and often before issuance, what MSCI will do is they will understand if the proceeds from that bond will be fitting into the kind of broad eligible categories outlined by the green bond principles. So an example of some of those categories are kind of alternative energy, energy efficiency, green building, sustainable water, climate adaptation. Now, what has to happen is that 90% of the proceeds of those bonds, and often this is kind of projected use of those proceeds, but 90% of the proceeds has to fit in to those eligible categories. Now, alongside that, at initial issuance, there's an additional rule that really ensures that there is reporting on the use of those proceeds or how they have been distributed within a year of issuance. And that reporting obligation really remains either until all the proceeds have been distributed or for the lifetime of the bond. Now, there's actually quite a lot of detail required from these annual reports. So obviously there has to be a list of the projects, including the kind of mapping to these broad project categories that I outlined earlier. There also has to be a summary of the project, what it's set out to achieve. And then finally, and very importantly for us, when it comes to impact reporting, there has to be a quantitative element to the environmental impact of the project pool. Now, that's fine and well. It's the beauty of indexing is we get this kind of very rules-based and transparent approach. But what happens if a bond has entered the index and it starts to kind of not meet these very transparent rules? Well, what happens is if the issuer doesn't report within 12 months, they get an additional kind of 3-month deadline to clarify, come up with a report. MSCI will often be obviously in direct communication with the bond issuer. And if the report is not received after 15 months, the bond goes on a watch list. And after 18 months, if no report has been received, the bond will be removed from the index and also considered ineligible for re-entry after that period. So what we have is a very kind of transparent rules-based approach from MSCI and Bloomberg in terms of how we ensure the proceeds stay green from these bonds. Now, in terms of managing our funds on a practical level, we obviously are in regular contact with MSCI as to their opinions on bonds, but that really comes from our expertise, which has been built out within our fixed income responsible investing team. And there we have our own proprietary methodology where every bond that is issued is given a green shade, so light, medium, and dark green. And with that comes alongside a kind of monitoring and analysis of green bonds and an annual verification that they're also meeting those reporting requirements. So it's really that kind of two-pronged approach which we think is particularly important for ensuring the proceeds stay green.
Thank you very much, Cara. Sheng, if someone asked you, how do you ensure the proceeds of green bond are spent on the actual projects that the issuer said they would, what would you say?
I'd say that it's fair to be cynical when an issuer says it's going to use the money for something. I think it's fair to be cynical and skeptical about such claims when we have witnessed, sometimes unfair representation by issuers. And so I think it's very important for investors to do their own homework with regards to the green bonds. And like what Cara said, it's great that the index providers actually follow up with the issuers at some point after the bond is issued to understand if there is actually an impact report and allocation report that sort of provides credibility or confidence that the projects were indeed financed by the green bond. And so for us at BNP AM, we actually do, we have a similar approach where we say that we would follow up with each green bond within our investable universe around 12 to 24 months after, right? And we try to understand in those reports the allocation percentages, which projects had received funding, the impact generated from those use of proceeds. And actually, we have had some cases in the past where we didn't get the transparency. We didn't get that ex post report. And what happened after that was, okay, yes, we have some engagement calls. We try to understand why they didn't want to publish a report to show to the market that they were indeed using the money as intended per the framework. And they just say, well, we just didn't think it was important enough. And so for us, we divested from that green bond from our fund, because for us, that really made the key. If there was no impact report, if there was no allocation report, it would be the same as a conventional bond anyway. Yeah. So from our point of view, for that green bond, we actually had taken it out from our portfolio and taken it out from our investable universe. But one more example, perhaps I could share with the rest, is that even if there were reporting, sometimes the details matter So for example, we actually just had an analysis done on a multi-utility, so in waste, in water, and in power. And actually, at issuance, the issuer had committed to spend some of the money on energy efficiency projects, which is great. Energy efficiency, we get to save some power, we get to reduce and avoid some CO2, and that's fantastic. But when we looked at the experts report, we were actually surprised to see some money being used for energy efficiency for a combined gas power plant, right? And for us, that was, we confirmed that with the issuer, and for us, we had divested from that green bond after that meeting. So for us, it's just like we do not want to be associated with fossil fuels assets for green bonds, and I think the exports transparency gave us that confirmation that okay, if there was the association, we are out. So I think every investor needs to do their own homework with regards to how the money was actually used.
Thank you, Sheng. Thank you. And I believe that Peter from Manulife, you're back with us.
I am. Sorry about the technical challenges.
No problem. No problem. Thank you. Okay. Sheng just talked there about lack of transparency means that you could just be investing in a green bond could just be the same as a normal traditional bond. So the question is, with the supply and demand imbalance of the green bond market at the moment that we're all aware of, are investors losing money maybe by perhaps pursuing the green bond route to try and cut emissions within their portfolio?
Yeah, that's a great question, and maybe we can tackle it in a few different ways. Firstly, sort of empirical experience, looking back at history. So, our experience here at Manulife, particularly with our Asia sustainable bond strategies, is that, when we look at the attribution and we look at where that's coming from, we're seeing some very positive attribution coming from green bonds and coming from bonds that we'd see as best in class from a sustainability perspective. So I think definitely from this sort of historical perspective, looking back, we've definitely seen good performance coming from more sustainable investments. Secondly, I'd say that companies that are proactively addressing climate risks in their business, they often tend to be companies that are addressing other systemic risks in their business as well. My feeling is that they often have fairly robust risk frameworks, and they're well-governed companies. And if you think about the risk to a fixed income portfolio, really that risk of sort of permanent loss of capital, permanent loss of wealth, really comes from when an investment defaults. And I think that kind of mindset, that management of risk that you see in that type of company, really helps mitigate that tail risk, which is something that you really worry about as a fixed income investor. In terms of the supply-demand imbalance, I think these tend to get purchased more by long-term buy and hold investors who, tend to focus more on those long-term climate risks. And I think that benefits companies as well, because it allows them to diversify their funding sources and potentially have a kind of a more stable capital base. So I think the issuers benefit by raising proceeds to reduce climate risks. And maybe that slightly improves their cost of capital. But I think it also diversifies their investor base, reduces refinancing risk. And I think investors benefit to the extent that reduced risk reduces default risk. So I think you're fairly compensated for investing in general.
Great. Okay, thank you very much, Peter. Thank you. Ray, of course, green bonds is not the only way to fund the transition, of course. I mean, what alternatives are you seeing at the moment that could help investors achieve a low carbon portfolio?
Yeah, that's a good question, Mark. I mean, green bonds, we're definitely seeing the growth of the market and the maturation, which people have talked about. But I think for me, it's about greening the whole brown side of the market. Ultimately, that's going to lead us to the economic-wide transition we need. So greening existing brown bonds, obviously we've seen a huge growth in sustainability-linked bonds and sustainability-linked loans the last year or two especially. There's been a move also on the sovereign debt side. So how to integrate climate and nature into sovereign debt investing, which is also quite a big percentage of the market. I mean, green bonds are still a couple percent of the market, vis-a-vis the difference between, let's say, corporate and sovereign. So I think for me, that should still be the focus. And we should be looking at how to, green the debt market entirely, as opposed to only looking at the green niche. So I think it plays a role, but it certainly cannot get us to where we need to get to in the time we have. And, having emissions by 2030 requires a wholesale transformation of the finance sector, including, greening of the brown debt market or the mainstream debt market as well.
And Cara, largely the same question to you. And if an investor doesn't want a green bond or can't find a green bond that's suitable, what are the options?
Yeah, I think actually you made a very interesting point in your introduction where you said kind of ESG investing is a broad church. And certainly when it comes to kind of green investing or climate investing, I wouldn't say broad church. I think there are some quite kind of clearly defined ways, but there is a spectrum on which investors can think about incorporating climate risk within their fixed income portfolios. So the first and kind of most simply is really around reducing exposure, and those are solutions that are probably looking to reduce exposure to the highest carbon emitters. Often those solutions are coming kind of in partnership with broader ESG integration alongside things such as fossil fuel screens. So I think that tends to be kind of the traditional way of greening and kind of making sure that we're using capital to help create greener economies. The second is really around prioritizing. So, companies or governments who are committed to seeking actions and reducing reliance on fossil fuels, and also often in partnership with more science-based targets. And there, I think actually, in terms of prioritizing issuers, this has been particularly important in areas such as government bond investing, where a lot of the time investors are not looking to divest from specific sovereign issuers, but what they are able to do is kind of reweight those issuers who, for example, have lower transition risk or lower physical risk, and greater resilience to kind of from an institutional perspective in terms of their ability to manage kind of climate events. And then I would kind of echo Ray's comments in terms of the sustainability linked bonds and loans. I think that's kind of a huge growth market, certainly in terms of more targeted pure play investing. I think we're likely to see more solutions kind of come to market that investors can really use. And the thing that we have to remember, if the green bond market is still feels quite small today, sustainability linked market is a fraction of that as well. So often these ideas of kind of prioritizing and reducing are where we have scale today. Whereas kind of sustainability linked bonds, pure play, it's a fantastic way to focus on green. But often we're having to wait until these markets really kind of come to size before they can play a much larger role in portfolios.
Yes, Cara, you're right. I mean, these are very small markets, and of course companies, especially large ones, they do have to raise a lot of debt on their operations, their growth. And it's interesting that Sheng, are you seeing more sort of green terms being written into the covenants of more mainstream debt? Is that something you're coming across?
Well, you know what, Mark? I think the short answer is no, unfortunately for us. Well, I think in a stricter sense, if covenants are like contract terms, right? And if a bond issuer breaks the piece of that bond contract, the consequences are a bit disastrous for the bond issuer. Now, even in a green bond context, if you read the prospectus of green bonds, a failure to allocate the bond proceeds to the user proceeds, as indicated in the framework, that's not a breach of contract terms according to the prospectus. So really speaking, it's still very much a gentleman's agreement between the investor and the green bond issuer, right? But if you think about it, it's from a game theory perspective, it's like a infinite step of a prisoner's dilemma game where it's there's always this interaction between the issuer and the investor and the market. And so from an issuer perspective, there is quite a bit of incentive to follow through the commitment as per the framework in order to allow itself for future financing of green bonds. Now, just now, Ray and Cara mentioned about SLBs, and I think that's where we start to see a little bit of covenant related or the spirit of covenants being factored in. So SLBs today, the sustainability-linked bonds, most of them today are related around climate-related metrics, CO2, GHG, sort of targets sometime in the future, right? But it's also important to know that those are not covenants in the stricter sense, because when an issuer, hypothetically, if it fails to achieve those targets, most of the time they pay a small penalty. It's not a default event. They only pay a small penalty in terms of a high interest rate. Interestingly, just one example really recently, the maximum penalty that I estimated for an issuer to pay investors if it failed to meet the target was €3 million, 3 million euros, right? That's for a €6 billion annual revenue company. So when you think about that, the maximum penalty that the issuer pays is really quite insignificant compared to its annual revenue. And so we're not there yet, but I think we're starting to see glimmers of covenant light being written into that.
Yes, I think a lot of these companies do continuously come back every 3-4 years to the market to raise capital. So I'm sure if lenders all started thinking the same, maybe they could make the covenants a little stronger. But thank you very much for that. Peter, surely what we need when it comes to funding the transition is more about the dirtier companies, the heavy emitting companies, the oil and gas companies, that they need to come to the green bond market and they start looking to raise capital to sort of clean up their operations in some way. What needs to happen to get more of those companies to come to market?
Yeah, I think you're absolutely right, and I think it might be helpful to kind of start from why companies should be decarbonising, and obviously given the Paris commitments and the net zero commitments by governments, I think we can expect ongoing encouragement and regulatory change that's really going to penalise those companies that are emitting lots of greenhouse gases. So it's really in companies' best interest to raise finance to support this. And I think there's kind of a clear link between companies and asset owners and asset managers to kind of decarbonize to achieve better outcomes for all sides. I think it's also kind of helpful when you're engaging with companies to really look at the demand side of the equation. If you look at, say, signatories to the UN PRI, those have gone up substantially over the past 2 years, probably well over 1,000 additional signatories, at least 50% more assets under management signatories to the UN PRI. The Principles for Responsible Banking has seen massive growth since it launched in 2019. I think around 40% of banking assets now are covered by the Principles of Responsible Banking. And obviously, we're seeing net zero targets being made by companies in the financial sector as well as the wider sector on a regular basis. So the conclusion to me is that there's a lot of demand existing now, and that demand will continue to grow because of those commitments that are being made by the suppliers of finance. And so that should mean that it's, to my mind, that it's logical for companies, therefore, to respond by issuing sustainable debt, recognizing this is going to be an area in which there's really strong demand. And I think it's also helpful just to kind of talk to companies about the various options they have. Some of my fellow panelists were covering transition bonds just now, sustainability linked bonds, and there's various routes depending on what the company's operations are for them to raise funds in this way to decarbonize. But I think overall you've got that incentive for supply coming from the level of demand that there is.
Gotcha. Thank you, Peter. And Ray, just moving to the final questions now. What investor trends are likely to emerge when it comes to funding the path to net zero? Because this does seem to be a long-term problem.
Yeah, true, Mark. And I think it's a long-term opportunity as well. I mean, clearly investors will, and the wider market will get a greater awareness of climate change as a material risk, as a systemic risk as well, as they fund a path toward net zero. I think we also need to deal with, the market construct stuff around, passive and active investment and what that means for net zero finance. But as I was kind of intimating, there are new opportunities. I mean, the food sector is changing quite rapidly. Perhaps it's where the energy sector was a few years ago. And fellow panelists have already highlighted opportunities around renewables. There's also the materials sector, automotive, et cetera. So I think that there are a lot of trends. I think the other kind of wider trends to emerge around company engagement. I think I'm already seeing a lot more discerning company engagement by financial institutions. And I mean, ultimately, I think it'll be difficult, but banks and financial institutions will have to say no at some point to certain clients if they don't meet criteria, if they don't publish transition plans and are not commensurate with a 1.5 degree world. And that's always a difficult conversation, but clearly the finance sector want to move companies and the economy down this path. But we need to discern those companies that are doing that properly and not, and the finance sector needs to consider that. And I guess finally, the pressure is mounting from customers, from NGOs, from staff within financial institutions themselves, to do this earnestly. So I guess those trends are likely to accelerate and continue, making this all the more important.
Okay. Thank you, Ray. Cara, same question to you. What trends are you expecting to see in the coming years?
Yeah, I think very much when answering this question, I try to take the trends that we have today and think about how they will continue to evolve going forwards. And really, when we think about investors integrating sustainability within their broader portfolios, but particularly their fixed income allocations, the bulk of where we see flows coming from are investors switching from non-sustainable to sustainable versions. And so that may be that they're holding an active fund, it may be that they're holding a fixed income ETF, but what they're looking for is exactly the same kind of exposure, but with sustainable integrated within it. Now, what we know is really if we look at kind of this year's flows in particular, what we think is that regulation has been the largest driver of what we call this kind of switching trend. And a large part of that has really been SFDR, obviously at a European level, but we continue to see kind of individual country level regulation, FEBLFIM in Belgium, AMF in France kind of continue to also push forward and become more specific in what they're asking for in sustainable labeled products. My expectation is very much that the regulation will also kind of continue to push forward on this path to net zero. I think what we've seen in terms of the level of transparency in terms of PAB and CTB benchmarks is going to be particularly important in an area of investing where, frankly, investors are often on a learning journey, and they're coming to larger institutions to understand how that path to net zero could look. I think they get kind of additional assurance when we see the regulation come out. So I think that's a particularly important trend that's going to pay forward. The second is really this idea of in areas where we think more thematically, such as kind of government bond investing, where there is a focus on perhaps just the E element as a sole theme. That when we're thinking about climate risks, we're really looking at forward-looking indicators, and there I think science-based targets are particularly important. So these are all kind of questions that we're hearing today, and I think kind of expecting to translate into flows and momentum in future trends. And then finally, kind of going back to the green bond theme. Obviously, the amount of issuance that we continue to see come is extremely important, but I would also tie that kind of with the diversity of issuers that continues to grow. And that's not just in the sovereign space, where obviously we're seeing regular first-time issuers come to market, but also within the corporate spaces as well. Now, as we get that diversity of issuers grow, what it means is that investors can become more granular about the parts of the green bond market they would like to invest in, or they can think about it from a broader perspective, and they can get a kind of yield and duration that they would perhaps expect from a more aggregate type exposure. So that growth in the green bond market, I think, will continue to push investors to use green bonds, but means that green bonds can actually play a greater and greater role in terms of not just achieving that path to net zero, but also continuing to achieve the financial objectives of investors' portfolios as well.
Thank you very much for that, Cara. Thank you. And Peter, the final word on this particular session goes to you. What trends are you going to be looking out for in the coming years?
Well, thank you. So I think really what we're hearing very loudly from clients is they want options. They want solutions that deliver good risk return profiles and an alignment to net zero. And the way we are trying to respond to that is creating frameworks, is developing in-house models, and also utilizing best third-party data that we can acquire to really measure alignment by companies to net zero, and then making net zero a real priority for our engagement program. And then obviously we apply that in the context of investors with a lot of investment skill in a particular area, accompanied with sustainability skills, which enables you to create products which we believe will have strong risk reward profiles, as well as helping investors to achieve net zero. So I think that's really the trend that we're going to see over the next few years.
Thank you very much, Peter. Thank you. I mean, this is a topic that we're going to, if we're going to achieve these targets, this topic is huge. It's not just in the ESG space, but in the mainstream thinking too. So I'm sure this is a discussion that it's going to remain on our schedules for some time to come. But for now, I would like to thank each of you, Ray, Sheng, Cara, and Peter, for your time. Thank you very much for sharing your thoughts with us. It's been great.